the S&P 500 strategy that built generational wealth. Have you ever noticed that when people ask, "How's the stock market doing?" they're usually talking about the S&P 500? That's because the S&P 500 has become the benchmark for the US stock market. It tracks 500 of the largest publicly traded companies in America and represents roughly 80% to 85% of the US equity market by value. But here's something many new investors don't realize. You can't actually buy the S&P 500 itself. The S&P 500 is an index. Think of it as a scoreboard that measures the performance of America's largest companies. What you can buy are funds designed to track that index. And that's one of the simplest ways to invest in the long-term growth of the US economy. Why do so many investors choose the S&P 500? The answer starts with diversification. With a single investment, you gain exposure to hundreds of companies across technology, healthcare, financial services, consumer goods, energy, industrials, and more. Instead of trying to predict whether Apple, Microsoft, Nvidia, Amazon, or another company will outperform, you own all of them through one fund. Historically, this approach has also delivered strong long-term results. Markets experience recessions, inflation shocks, political uncertainty, and volatility. Yet over long periods, the S&P 500 has consistently rewarded patient investors who stayed invested. So how do you actually invest in it? The most common method is through exchange-traded funds, or ETFs. Two well-known examples are the State Street SPDR S&P 500 ETF Trust, ticker symbol SPY, and the State Street SPDR Portfolio S&P 500 ETF, ticker symbol SPYM. Both are designed to track the performance of the S&P 500. SPY is known for its enormous trading volume and liquidity. In fact, it remains one of the most heavily traded ETFs in the world. SPYM takes a different approach. It offers similar exposure to the S&P 500 while focusing on keeping costs extremely low, which can be attractive for long-term investors. Another option is mutual funds. Many retirement plans, including 401ks and IRAs, offer S&P 500 index funds. These operate similarly but trade only once per day after markets close. And technically, you could build your own version of the S&P 500 by purchasing all 500 stocks individually, but that's usually impractical. You would need to constantly rebalance positions as market values change. ETFs and index funds handle all of that automatically. Getting started is surprisingly straightforward. First, open a brokerage account or use an existing retirement account. Second, transfer funds into the account. Third, search for an S&P 500 fund such as SPY or SPYM. Fourth, decide how much you want to invest. Many brokers now offer fractional shares. Finally, place your order and consider setting up recurring contributions. For many investors, consistency matters more than timing. One of the most powerful benefits of investing in the S&P 500 is compounding. When returns generate additional returns year after year, growth can accelerate dramatically over time. A disciplined investor who consistently contributes and stays invested often benefits more than someone constantly trying to predict short-term market moves. And that's really the core lesson. The S&P 500 isn't about finding the next winning stock. It's about owning a broad slice of America's largest businesses and allowing time, diversification, and compounding to work together. You can't buy the S&P 500 directly, but through ETFs, index funds, and retirement accounts, you can invest alongside many of the world's most influential companies. And for generations of investors, that simple strategy has remained one of the most effective ways to build long-term wealth. The question isn't whether you can buy the S&P 500. The question is whether you're giving time enough opportunity to work in your favor.